As of right now, on this Saturday, November 22, 2025, the U.S. markets are closed for the weekend, which means we are analyzing the final closing data from yesterday's session. Medical Properties Trust, trading under the ticker MPW, finished the trading week at exactly $5.30 per share. That figure might look like just another number on a screen, but the price action leading up to this close tells a story of a company that is aggressively fighting to reclaim its footing. In the after-hours session yesterday, we saw very little deviation, holding steady at that $5.30 mark, which suggests that traders are taking a breath to digest what has been a truly chaotic but potentially lucrative few weeks for this healthcare REIT. The intraday movement on Friday was tight, oscillating between $5.15 and $5.35, showing that a floor is forming, but the real story isn't just in the daily fluctuation, it is in the massive disconnect between what the average retail trader thinks is happening with this stock and what the institutional data is actually screaming at us. When you look at a stock like Medical Properties Trust, the expectation from the broader market, especially if you scroll through forums on the Robinhood app or browse the chatter on SoFi Invest, is that this is a damaged company. The narrative that has plagued MPW for the last 2 years is that it is a value trap, a falling knife that you should not catch. People see the ghost of the Steward Health Care bankruptcy, which we will discuss in depth later, and they assume the bleeding has not stopped. They expect a dividend cut, they expect further tenant issues, they expect the stock to drift back down toward the $3 range. That is the expectation. Here is the reality that hit the market just a few days ago. MPW did not cut its dividend. It raised it. On November 17, 2025, the board declared a 12.5% increase in the quarterly dividend to 9 cents per share. This is the exact opposite of what a dying company does. A company running out of cash does not hand more of it back to shareholders. This move signals a level of management confidence that completely contradicts the bearish thesis, and it creates a massive tension in the price. You have a stock priced for failure, yet behaving like a growth engine. That gap between price and performance is where the opportunity usually hides. Let's look closer at this recent movement because it is critical to understand why this $5.30 price level is so psychologically important. For the better part of 2024 and early 2025, MPW was essentially in the penalty box. Investors were punishing it for its overexposure to a single struggling tenant. But fast forward to late 2025, and the landscape has shifted. The trading volume we saw this past week was robust, consistently staying above the 30-day average, which indicates that institutions, the big players managing Fidelity wealth management accounts or massive pension funds, are stepping back in. They are not just nibbling, they are accumulating. When you see a dividend hike combined with a $150 million stock buyback program, which was also recently announced, you are seeing a company utilizing its capital to force a floor under its price. This is a classic bear trap scenario. The shorts, those betting the stock will go down, are suddenly looking at a yield that is rising and a share count that is shrinking. That is a recipe for a squeeze. And the upward pressure we saw heading into the Friday close is likely the early rumbles of that mechanism kicking in. It is interesting to compare the sentiment here to something like Tesla stock. With Tesla, you accept massive volatility for the promise of future tech dominance. With MPW, the volatility was never supposed to be there. This is a real estate investment trust. It is supposed to be boring. It is supposed to be the kind of stock you park in your Schwab intelligent portfolios and forget about while it generates passive income. But for the last 2 years, MPW traded with the volatility of a crypto asset. What we are seeing now in late 2025 is the beginning of a return to boring. And in the world of investing, boring is often where the real wealth is compounded. The recent earnings report from October 30, 2025 showed us that while they missed slightly on earnings per share, their revenue actually topped estimates, coming in at strong levels that prove their other tenants are performing well. The market initially dipped on the EPS miss, but then ripped higher in the following days as smart capital realized the revenue quality was improving. Now, we have to address the elephant in the room, or rather the ghost in the hospital hallways, Steward Health Care. You can't talk about MPW without explaining this because it's the anchor that dragged the stock down for so long. For those who use Interactive Brokers stock trading platforms and look at the long-term charts, you see that massive drop from the highs? That was largely due to Steward, which was MPW's largest tenant, filing for bankruptcy. The expectation was that MPW would lose all that rent, be left with empty buildings, and default on its own debts. It was a doomsday scenario. But the reality of the resolution has been far better than the fear. By September 2024, MPW had effectively taken control of the real estate, severed ties with Steward, and began handing operations over to new, healthier operators. Now, in November 2025, we are seeing the fruits of that painful transition. The new operators are ramping up payments. We are not just hoping for rent, rent is being collected. The buildings aren't empty, they're treating patients. The crisis has passed, but the stock price is still lingering as if the crisis is ongoing. That lag, the time it takes for the market to realize the fire is out, is the zone where value investors usually like to operate. If you're sitting there with your Fidelity mobile app open looking at this chart, you might be wondering what exactly this company does to generate this cash. It's important to strip away the ticker symbol and look at the business. Medical Properties Trust is a landlord, but they aren't renting out apartments or strip malls. They own hospitals, critical infrastructure. When you own a hospital, your tenant is usually sticky. A hospital operator can't just pack up their MRI machines and move down the street to a cheaper location next month. These are massive, regulation-heavy, capital-intensive operations. This gives MPW huge leverage. They use a triple net lease model. If you're new to online investing or just starting to invest online, this term is crucial. In a standard lease, the landlord might pay for maintenance, insurance, and taxes. In a triple net lease, the tenant pays all that. MPW just collects the check. They provide the capital for the building, and the hospital operator takes care of everything else. This means MPW's margins are generally cleaner than a typical apartment REIT. The risk, of course, is that if the tenant goes broke, like Steward did, the landlord has a problem. But as we have seen, hospitals are essential. Even when the operator fails, the building usually needs to stay open for the community, which means a new operator eventually steps in. Comment below how many shares of MPW you currently hold, or if you have been watching this turnaround story from the sidelines. I want to hear if you think the dividend hike is sustainable or just a trap. Let's talk about the broader sector for a moment. Healthcare real estate is often considered defensive. When the economy slows down, people stop buying new cars or upgrading their iPhones. So stocks like Apple might see revenue fluctuations, but people don't stop getting sick. Surgeries, emergency room visits, and rehabilitation are not optional. This demand inelasticity is what provides the floor for MPW's business model. However, the macro environment in 2024 and 2025 was tough because of interest rates. REITs are sensitive to interest rates because they borrow capital to buy buildings. When rates are high, their borrowing costs go up and their profits go down. But now, as we look toward the end of 2025, the Federal Reserve has been signaling and enacting a more dovish stance. As rates stabilize and potentially inch lower, the cost of capital for MPW decreases. This is a double tailwind. Their tenants are healthier, and their debt is becoming more manageable. For the individual investor using Robinhood fractional shares or managing a SoFi robo-advisor account, the question is often about yield versus growth. MPW is currently a yield story that is morphing back into a growth story. The yield, sitting around that 7% mark after the hike in price adjustment, is significant. In a world where savings accounts are starting to pay less as rates drop, a 7% yield from a tangible asset backed by real estate is attractive. But the growth part comes from the re-rating of the stock. If MPW simply returns to a valuation multiple consistent with its peers like Healthcare Realty Trust or Physicians Realty Trust, the share price would have to move significantly higher than $5.30. We are talking about a reversion to the mean. The market hates uncertainty, and for 2 years, MPW was pure uncertainty. Now that the uncertainty is fading, the risk premium